Today, property signs for the 22nd of June 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. Today we look at the reaction to the first home buyer changes, the moves that China have taken against Bitcoin and its impact on cryptos more generally, and the latest from the Fed as they continue to hold the line on the transitory nature of inflation in the economy. And before we start, a quick reminder that at 8 p.m. Sydney time tonight, I'll be running my next live stream event. Unfortunately, Tony Lacantro, who's going to join me to talk about current investment strategies, is unavailable due to personal reasons. So I'll be running the show, but nevertheless, we'll be able to discuss some of the latest data and also some of the market movements and what they mean. So I look forward to seeing you then, 8 p.m. Sydney time. The links are in the comments below. In Australia's largest capital, first home buyers have been feeling the pinch for many years. While Sydney has remained the most expensive place to buy property, the rest of the state of New South Wales has followed suit, with the average dwelling price exceeding $1 million during the March quarter, according to the most recent figures from the ABS. In the light of this new record, the CEO of REI NSW, Tim McKibben, told MPA that housing affordability was a huge issue. Well, he's not wrong there. It's a very serious problem for anybody trying to get into the market, and I can't see that improving in the foreseeable future, he said. Despite the noise made by politics and the media in recent years, McKibben says the only way to solve the affordability crisis was to increase housing supply. We're in a market where demand is greater than supply, he said. Demand is growing and the supply is not even keeping pace with that. And he said that the often lengthy development approval processes of local councils were an impediment to increasing housing stock. Some LGAs take as long as 12 to 18 months to reach a verdict. The other thing that's not well known, because it's not transparent, is that when somebody buys a new property, 40% of the cost the consumer pays are in taxes and charges, he said. As an example, when you look at a new property based on the median house price of $1 million, the property consumer is paying $400,000 of that acquisition in taxes and charges. To me, this is another area that we should be looking at to improve affordability, he said. Now, I've got an issue with this insofar that I don't believe that supply is the problem. Credit availability is the problem. Credit availability has pumped up mortgages, pumped up prices, and pumped up mortgages more. So what we have to do is to get credit under control. In fact, there is plenty of spare property around, despite what everybody is saying. And there's more coming, partly because we're still building more stuff, particularly apartments, high rise at that, and also more people are likely to sell in the months ahead. So don't believe the real estate spruiking about build more stuff. That won't solve anything unless you deal with the credit side of the equation. Now, according to CoreLogic's head of research in Australia, Eliza Owen, there's been a marked decline in the number of Australians achieving home ownership as property prices have surged. Rising property prices and higher deposit hurdles have created more of a barrier to home ownership over time, with the ABS data suggesting the portion of Australian households that own their own home with or without a mortgage has fallen from 71.4% in 1994-5 to 66.2% as at the 2017-18 financial year, she told MPA, and by the way, it's got worse since then. In New South Wales, the gap between income and home values has created a challenging environment for first-home buyers, saving a deposit despite serviceability improving through lower interest rates. As at September 2020, the dwelling price to income ratio sat at 8.6 for Sydney and 6.7 for regional New South Wales, she said. It was estimated that it would take 11.4 years for the typical household to save a 20% deposit on a Sydney dwelling and 9 years across regional New South Wales. And of course, since then, interest rates have dropped even more. And CoreLogic shows that since then, in the 6 months to May 21, the median house value in Sydney has shot up from $1 million to $1.2 million. The other tricky dynamic for breaking into home ownership is a tightening rental market, particularly across regional New South Wales, where rents have risen 10.2% over the year, Owen said. This will make it harder for renters to save their deposit. Well, although interest rates have improved the serviceability of many borrowers, the end of the TFF could mean less buyers in the market, which could ultimately slow things down, she said. Higher mortgage rates or tighter criteria around lending will ultimately dampen demand for property, she said. An uplift in lending rates should start to see house prices flatten out or decline. So there you have it, very clearly. It's a credit-driven issue that's making house prices go higher. But McKibben said that while high interest rates will lead to buyers taking less money to the auction, the effect may not be across the board due to the lack of transparency around how much money returned expats are bringing to the table. To increase supply and address housing affordability, McKibben suggests reforming the development approval processes on a statewide level. Developers say to me, it's never yes, it's never no, it's maybe. Maybe is very expensive, he said. What councils should do is to have envelopes in their municipality. They should say, inside of this envelope, you can build this. According to Owen, approaches to addressing housing affordability depends on ideology, how housing is viewed, and the broader financial parameters a country operates in. For example, in Australia, home ownership has been an implicit pillar of retirement to avoid housing costs later in life. But the high value of housing has also been a source of wealth for funding aged care, healthcare, or the transfer of intergenerational wealth, she said. In this sense, home ownership and high-value homes are both fundamentally for the current direction of self-sufficiency in retirement that Australian institutions work towards. And she said that the younger cohorts of buyers have experienced a larger decline in the rate of home ownership over time compared with older cohorts. First home buyers appear to be the most price sensitive when it comes to participation in the property market because they may not have an existing asset that can keep pace with gains in the market, she said. Low income households also persistently have lower rates of home ownership. And she compared recent policies from the federal government and the opposition, pointing to the coalition's leg up over deposit hurdles approach to helping more buyers onto the property ladder while maintaining property values. This is very different to the Labor opposition platform in 2016 and 18, which centred on the demand-side approach to affordability around reducing negative gearing and capital gains tax concessions, she said. Speaking more pragmatically, rising rents and property values are not only creating a barrier to home ownership, but may lead to greater levels of housing stress and insecurity. An obvious place to start would be creating more public or social housing for the most vulnerable Australian households. While I agree with her on that, we absolutely do need public and social housing strategies. There's probably a need for around 250,000 homes across the country as a starting point, designed specifically to offer affordable housing for those who can't get into the market. That would actually take quite a lot of pressure off, but of course is ideologically opposed to the current government. Over in the US, the Federal Reserve Chair Jerome Powell said that inflation had picked up but should move back towards the US Central Bank's 2% target once supply imbalances resolve. Inflation has increased notably in recent months, Powell said in a written remark, prepared for his Tuesday testimony before the House Select Subcommittee on the coronavirus crisis, citing increases in oil prices and a rebound in spending as the US economy reopens. As these transitory supply effects abate, inflation is expected to drop back towards our longer-run goal, he said. Powell's remarks reprise his opening comments from his 16th of June press conference following a policy meeting of the central bank. Investors will tune in to the hearing on Tuesday in the US for potential questions that may shed more light on his views on the pace of the economic rebound and for how much longer the central bank should keep its monetary policy on an emergency footing. Fed officials surprised financial markets last week when their forecasts showed they pulled forward their expected timing and pace of interest rate increases from the current near zero level, while also kicking off a discussion of when to taper asset purchases from their current $120 billion a month pace. The quarterly projection showed 13 of the 18 officials favoured at least one rate increase by the end of 2023 versus 7 in March, and 11 officials saw at least 2 hikes by the end of that year. In addition, 7 of them saw a move as early as 2022, up from 4. And the projections also showed that officials' sense of risk and uncertainty around their inflation forecasts actually moved higher. The Fed's signal on inflation vigilance had an immediate impact on financial markets, raising short-term rates and flattening long-term yields, narrowing the spread between the 5-year and 30-year Treasury yields. And Powell continued to sound optimistic on the outlook for employment in his congressional testimony. Job gains should pick up in coming months as vaccinations rise, easing some of the pandemic-related factors currently weighing them down, he said. Sub-Fed officials estimate that the central bank may need to tighten policy sooner than it expects, and the publication of Powell's testimony follows remarks earlier on Monday from his colleagues on both sides of that debate. James Williams, president of the New York Fed, said he expects bottlenecks and imbalances produced by a strong recovery to subside, bring inflation down to around 2% next year and in 2023. It goes without saying that there is a great deal of uncertainty about the inflation outlook, and I'll be watching the data closely, Williams told the mid-size Bank Coalition of America. But Dallas Fed President Robert Kaplan said he favors starting the process of tapering the central bank's ongoing bond purchases sooner rather than later, while his counterpart from St. Louis, James Bullard, called it appropriate that policymakers last week opened the taper debate. Neither Bullard or Kaplan votes on the Federal Open Market Committee this year. And US central bankers predict that their preferred price measure, the Personal Consumption Expenditures Price Index, will rise 3.4% this year and then de-accelerate to 2.1% and 2.2% over the next 2 years, according to median estimates. The most recent reading on the inflation index, the Consumer Price Index, rose 5% in May from a year earlier. Meantime, fears of crypto trading suspensions in China dragged the price of Bitcoin down, taking altcoins with it, as China's central bank has issued guidelines for a harder crackdown on crypto. Bitcoin and crypto prices crashed on Monday after the news broke out, with experts warning this crackdown is more serious than previous ones. The implementation of further bans in China threatens a huge setback for crypto markets. China summoned officials from its biggest banks to a meeting to reiterate a ban on cryptocurrency services. Representatives from Industrial and Commercial Bank of China, Agricultural Bank of China, and payment service provider Alipay were reminded of rules that prohibit Chinese banks from engaging in crypto-related transactions, according to a statement from the central bank on Monday. The latest development is a sign that China will do whatever it takes to close any loopholes left in crypto trading. And in May, China's State Council, the country's cabinet, called for a renewed crackdown on Bitcoin mining and trading activities. China has long-standing rules that bar banks from offering crypto-related services, but in recent years, individuals have moved to trade the digital coins on over-the-counter platforms and even offshore exchanges. Crypto activities disrupt financial order and also breed risks of criminal activities like illegal cross-border asset transfers and money laundering, according to the statement from China's central bank. The financial companies have pledged to step up inspections into crypto activity and close related accounts, and they won't offer account opening, clearing, or settlement to assist crypto trading, they said. China Construction Bank, Postal Savings Bank, and the Industrial Bank Company were also at the meeting, according to the PBOC statement. The country's tough regulatory stance is in contrast to the US, where crypto trading is big business. Banks such as JP Morgan Chase, Goldman Sachs and Morgan Stanley are beginning to wade into the industry and offer products for wealthy clients that want access to the volatile asset class. This will of course cause some short-term volatility, but should not have mid- and long-term effects for Bitcoin, said Antony Treviv, co-founder of Nexo, a crypto lender. The Agricultural Bank of China actually published a letter on its website early on Monday ordering the prohibition of crypto-related services. Crypto Briefing confirmed from 2 independent sources that the post was taken down in just a few minutes. However, the contents of the post left crypto investors terrified. In the letter, the third largest bank in China released a formal statement of virtual currency transactions, making clear its intention to prohibit service to account holders and service providers involved in Bitcoin transactions. Hours after the deleted letter was shared on social media, the country's central bank confirmed the fears of a stricter regulatory crackdown. The People's Bank of China is looking to discontinue services to account holders and entities involved in crypto trading. While reiterating a crypto ban in China may sound redundant to investors who have been around for some time, experts have raised a serious cautionary flag this time. The recent crackdown began in May after the Financial Committee of the State Council vowed to curb wasteful mining and irresponsible trading practices in the country. Since then, local governments have enacted a ban on all major mining provinces. Today's banking scare from the country's central bank has intensified the fears of trading prohibitions, threatening a major decline in crypto trading volumes. Davi Wan, a Chinese crypto investor and founder of Primitive Crypto, tweeted that now it's about the time for the worst, at least for the mainland, to come, and she noted that the crackdown could expand to OTC desks and exchanges. Wan added that the recent meetings were about collecting data and information and observing market and industry feedback, and that the government could take further steps soon. The Chinese government banned crypto exchanges in 2017, but crypto investors in China got around this ban by using OTC desks and foreign exchanges for trading. Bitcoin was trading 7.5% lower on Monday since the first report from the Agricultural Bank of China came out, and Ethereum dropped below $2,000, losing 11.5% on the day. Meanwhile, China continues to expand its central bank digital currency program, long considered a threat to the free use of decentralized cryptocurrencies in China. And speaking to Crypto Briefing, Crypto Hopper CEO Rudd Feldkamp said China is rolling out its own cryptocurrency and has every incentive to have as little competition as possible, adding that people still react strongly to actions from China that create uncertainty, so this is likely to reflect negatively on the Bitcoin price. And after this slew of news relating to the renewed crackdown from China, it triggered a Bitcoin sell-off, and chartists and analysts are turning to a sinister-sounding technical signal. The original cryptocurrency has formed what's called a death cross, meaning its average price over the last 50 days fell below that of its 200-day moving average. The indicator is typically seen as a closely watched technical measure, which could offer a hint at more pain to come. Many analysts had anticipated the coin amid a recent downturn that's seen it lose 40% over the past 2 months, would form that grim-sounding pattern. But there is some reason this time to believe that the formation this time around might not be as bearish a signal, as that 200 moving day average is actually still rising, according to Matt Manley, chief market strategist at Miller Tabak & Co. When it starts declining, that will be more compelling, he said. Indeed, Bitcoin's marking of a death cross in March 2020 proved no impediment to gains as it turned higher and formed what's called a golden cross, where the pattern is reversed 2 months later. But a death cross in November 2019 saw the coin trading lower 1 month later. And Bitcoin fell on Monday to a 2-week low, dropping as much as 11.4% at one point to $31,735 after China made those announcements. And this is, of course, the latest sign that China plans to do whatever it takes to close any loopholes left in crypto trading. The fact that there's a crackdown there perhaps does take away some of its luster, said Jeffrey Kleintop, Chief Global Investment Strategist for Charles Schwab. I'm not sure it's a signal of any longer-term change in direction, but it can certainly create some volatility. No one is sure of the extent of the crackdown, and China is an important player in the Bitcoin market. Some chartists also say that Bitcoin, which failed to retake $40,000 last week, could retest the $30,000 level, which it briefly touched during its brutal May sell-off. Should that happen, it could have a tough time finding support at $20,000. Other cryptocurrencies also retreated, and the Bloomberg Galaxy Crypto Index, which tracks some of the biggest digital coins, fell near 13% at one point, marking its lowest point since last February. And Bitcoin's gains this year have shrunk to roughly 11%, in line with the advance posted by the S&P 500 so far in 2021. The coin is on pace for the third straight monthly loss. There's a lot of fear, and when there's fear, people sell risky assets. I do think that Bitcoin's still perceived as a risk-on asset, Emptor, Chief Strategy Officer at CoinShares, said. Generally, investors are skittish. CoinShares have seen 6 weeks of outflows from the firm's exchange-traded products, and he said that investors are moving to stable coins such as Tether, which could push prices higher when there is a positive market catalyst. And finally, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investment that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you now have experienced, knowledgeable and master negotiators looking after your best interests. So shoot Ribbon an email on info@ribbonproperty.com.au and use the promo code DFAWTW/Martin to receive your 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.